Hello, Sharanya, can you hear me?
Yes, sir.
Okay, so should we begin?
We can wait for 1 2 minutes and then start.
Okay, okay, no problem.
Hello, sir. I think we can start.
Yeah, yeah. Okay, okay, good, good, good. Okay. Uh, so, yeah. So today we are going to talk about whatever is left mostly on the debt and the bond side, like the modeling of for the debt, credit loss modeling, and the default of a bond under various scenarios, like how much is the default and when is the default, what is the default percentage, what is the exposure, and we'll do a simulation of this and also show uh, if we can model it on the basis of Black-Scholes, so the debt port of a particular company or a particular portfolio can be modeled on the basis of the Black-Scholes Martin model. So we'll first do it a very basic one and then go on to Excel and do the complex one like deep modeling. So I'm sure all of you must be aware about these the credit ratings given by the various rating agencies. The two prominent rating agencies are S&P and Moody's. We have over here in India the CARE, ICRA, CRISIL, which are the part of S&P and Moody's, all this, and then there is Fitch rating, and then there is Brickworth rating. So these are the local Indian rating, but basically all the ratings, either in India or globally, they are in some collaboration with a Standard Poor or the Moody's or the Fitch. So some collaboration is always there between these, and same thing applies in India. So the most of the ratings given by, say, the rating uh, given by these rating agencies basically fall into the investment grade and the speculative grade. So the investment grade comprises of AAA, AA, single A, and triple B. And the speculative grade is below triple B. So like double B, B, C, D, all these are the speculative grade. So institutions are not allowed to invest in a speculative grade. That's why we need separate understanding of what kind of the ratings are given to the speculative bonds or speculative investments. So this triple, so there is slight variation between Moody and S&P, but by and large anyone can understand. So for example, S&P uses all triple A capital. Moody uses the first one capital and the last two as the small letter, but they signify the highest safety, the high quality, and strong payment capacity. And the triple B is where there is adequate payment capacity, but this possibility is that in future there could be some problems. So this is where after triple B there are problems in the ratings assigned to the bond. So for example, if a bond is assigned rating double B, plus and minus are like the notches, one up and the just like another further segregation within those ratings. So double B plus is also not bad in terms of its obligation, but where it's the problem is like if there are uncertain conditions. So for example, if the particular the economy issues related economy, so this may not uh, continue giving payment. So these are all basically rating. Why we are talking about the ratings is the payment in case of a bond, whether it defaults or it doesn't default, or if you have to assign a probability, and if you have to assign the chances that it will be downgraded or upgraded, because every time there is a downgrade and upgrade, there is huge amount of cash uh, outflow and inflows respectively, depending on whether it is a downgrade or upgrade, because the institution keep on moving from one rating to other. For example, if a triple B rated bond is on the next time of the review is rated double B, so all the institutions like pension funds and all the government investment corporations like the sovereign wealth fund, they will exit because their mandates don't allow them to be in a speculative grade. And as a result, what will happen? The prices of these bonds will fall and the yield will increase. So today we are going to talk about the ABC grade, not the AAA. I will tell you the reason. So let me move to the next slide. So after this slide, we'll continue on the Excel. So some background I wanted to give you. So what we are going to talk is about a bond. where F is the face value. So it could be 100 or 1000 depending on the situation. P, the price of the bond. So that same $1,000 bond could be bought at 990 or could be bought at 1100 depending on where the yield is, as all of you are aware. Q is the annual coupon rate of the bond. So the coupon rate is 4%, 5%, 8%, 10%, 7%, depending on like what were the interest rates prevailing at that point of time. Something important that we have brought in this case is the probability that the bond will default and will not default. So we are denoting this by pi. So pi is the probability that the bond will not default at the end of a year. So in 1 year framework, pi is the probability that it will not default. So most likely, if pi is 10%, so there is 10% probability that at the year end, the bond will continue making its coupon and the principal obligation, and there won't be default. Uh, but 1 minus pi is the like so. Then one if the pi is 10%, so 1 minus pi being 90%, 90% chance that bond may default at the end of the period. And then the next term that we have introduced is lambda, which is fraction of bonds value that bond holders will collect upon default. This is very, very important. This is something that is uh, very, very, very relevant to this portion of the session where we are going to talk. So what happens is uh, this you must be knowing about a company called Reliance Communication Limited. So Reliance Communication is the same Reliance which I think 10 or 12 years or maybe 15 years ago, it has started with CDMA services and then switched to GSM mobile communication, where it was giving SIM card and the handsets to subscribers. And then it had large number of subscriber base because it came with a big bank and it captured market share. And market was really very keen to give higher rating to this particular company. So the equity was also very heavily traded. And in the process, what happened, because if there is a good company and bankers know that this is the cash flow of this company is not going to be a problem, so they extend huge amount of loan. So I think the loan to Reliance Communication, as far as the court order which I saw, is something like 32,000 crore, somewhere between 25 to 30,000 crore. So just imagine a company amasses something like 25,000 to 30,000 crore, whereas as on date, the company claimed before the National Company Law Tribunal, where it is fighting a case and fighting with a case with creditor like Ericsson and all other bankers like SBI, and it's claiming that if it sells assets, it won't be able to recover more than 2,000 or 3,000 crore, though it has liability, huge liability. So coming back to this session, so lambda is what is available if the entire assets of a particular debtor is sold. So for example, if the loan amount is 1,000 crore and if you sell all the assets of a debtor and you get 200 only, so lambda becomes 0.2. So you will be only able to recover only 20%, not more than that. So lambda comes from there, and that like in case of all the debt obligation, lambda will depend on which company has taken the debts. Like with these parameters f, p, q, pi, and lambda, the expected end of year cash flow will be. This is important. So just memorize this or remember this. So if Q is the annual coupon rate of the bank, so let's say Q is 5%. So 1.05 will be the payment at the end of the year if the bond doesn't default. And because the face value of the bond is F, so F into 1 plus Q will be the payment at the end of the year if there is no default. So we multiply pi 1 plus Q into F, and then we say that if this is no default payment, but there could be default. So while calculating expected payment, we take both the scenarios of the default plus non-default, and these are two mutually exclusive events. So the second situation is 1 minus 5 means there is a default, and if default happens, the part of the face value F will be recovered, which is lambda into F. So if the 20% of the F is to be recovered, so 20% into 1,000, and that's how we do the recovery. We calculate the recovered amount in case of default. Moving to the last slide for this particular purpose. So if we have to calculate expected return, so whatever money that we have recovered at the end of the year, we'll divide by the price. Price is different from the face value. Why? Because prices keep on changing. As you are aware, prices keep on changing depending on the yield present in the market. Whereas the face value is when it is issued, and the coupon is when it is issued. So that's why, because coupon and YTMs are different, so prices will always be different than the face value of the bond. So we calculate 1 year expected bond return equals to the whatever expected cash flow at the end of the year, and divide this by P, and subtract from it the 1, because this is likely to be 1 plus something. So we get the fractional amount, and then we change into percentage. So this is how we do. So now we go to Excel with this background, that F, P, Q, pi, and lambda in our mind. We go to the Excel sheet, where I have shared with you also, so you can open that. And then let me see if this is visible on the screen or not. No, so this is not visible. So let me share it once again. So let me share. Yeah. So can you see my screen, Sharanya? Me, can you see it, my screen?
Yes, sir, we can see it clearly.
Yeah. Okay. So so we go to the practice exercise, where we do with the simple case, and then we move on to the complex scenario, where there can be numbers of situation, number of factors changing. So we are considering a bond which has a face value of 100, and it is being priced at 90. So because it is priced at 90, so market is expecting higher yield than this annual coupon of 8%. Okay. And the default probability given is 20%. So this is given to us. I will also tell you subsequently that how do we calculate default probability. But as of now, just take this value as given. So default probability is given 20%, and recovery percentage is given 40%. So now we will calculate the expected period 1 cash flow. So this is very simple. How? So what will happen? The period 1 cash flow will depend on how much we get in case there is no default. So we'll get 100 into 1 plus, and this coupon, this will get no default. But what is the default probability? 20%. So no default probability will be 1 minus 20%. 0.2 I will write. Okay. So this is one situation. The other situation is if there is a default. If there is a default, oh, this is taking as formula. So if there is a default, so that is 0.2. And in case of default, how much I get? The face value into the probability of default we have written, and the face B2 is face value, and the recovery percentage. Yeah. So with this, we are done with this expected period 1 cash flow, and then I press enter. So I get 94.4. So in the situation where there is a 20% default and recovery percentage is 40, most likely we will end up with 94.40 of the amount invested, like of dollar or rupee, whichever is at the price 90 bought. So the expected return, as you know, is very simple in this case. We'll divide this by the price, and then subtract from this, and we press enter, and we get 4.89%. So in the situation where the default probability is 20% and recovery percent is 40%, we get the expected return of 4.89%, which is a very basic case of a bond which has just 1 year horizon. Like if this is going to the tenor of the bond is going to get over in 1 year. Now we go and see the expected return
Sir, I
in
had a doubt.
yeah.
Sir, is it like that we calculate the returns for each scenario and then we assign the weightage of probabilities and then take the net of payment into probabilities and then take it as a sum of total basically?
No, no. So this bond has only 1 year horizon. Okay. So in 1 year horizon, so so what I understand from your question is basically you were talking about a scenario where like you are envisaging different scenarios. So for example, you want to assign a default probability of 10%, recovery percentage of 30% or 60%. This is what you are saying?
Yes, sir.
Yeah, because according to you, you are saying that all these scenario can change and you can take the expected value of that. So basically what you are talking about is a simulation scenario where like you want to simulate depending on of the various scenarios, which we'll do separately. But we are just considering a situation where you are given this default probability and the recovery percentage. Now, as I told you that how do you know what is the default probability? So there are models that can calculate default probability, and there are historical averages of default probability also. So an analyst can take it depending on the comfort that it has developed over a period of time. So all banks are all the uh, creditors, they know that what is the default probability of a particular loan type or a particular segment. And then again, recovery percentage, as I told you, this depends on like how much assets the uh, debtor has. So, for example, Kingfisher defaulted, but because there was guarantee, so whatever asset was there, the SBI sold it and encashed it. So this recovery percentage also can be found out. However, if you want to simulate it, then you need to change it. Otherwise, there is no need to change because there is 1 year horizon, and with these parameters given, you can just calculate the expected period
Hmm.
one cash flow and then the expected return. However, if these parameters change, so for example, if I change it to 10%, then obviously the values will change because that's how it is modeled. So this is for 1 year, 1 year scenario of a bond where you are considering that the bond can default at the before the term or may not default, but you are not sure, and then you have calculated it. Now we go to a multi-period scenario, which is more likely. Why? Because historically it has been seen, and that's a case that normally a bond when it is issued rarely defaults in the beginning. Why? Because if its condition is so bad, the ratings would be poor, and investor will not be very keen to invest in those kind of one, and accordingly even the issuer will know that this is going to be a problem, so issuer may not like to come up. So normally the first few years of a company's debt issuance, the situations are really good. So the first few years are not a problem. It's the middle of the year when there is a problem. Why? Because by then situations change. Its cash flow also can change because of the economic condition of the cycle that the economy goes through. So that's the situation when. So that's why multi-year period, like 3 to 5 year period of this simulation is very, very important. Why? Because then we can get to see that what will happen if there are the variables are changing. So what we are going to look into is we are going to consider four kinds of bond: A, B, and C. A, B, C, and D. Why we have not considered triple A, double A is because normally for a triple A bond to default, probably it will be very the probability will be very little. Of course, there is probability, but it's very little, even historically also or model wise also. The same applies to double A, but A can go to easily go to triple B or double B or B, and B can go to C, and then C can go to D. So we are going to consider these three situations where we are assigning rating of A, B, C, and D, where A, B, C are all yeah, not in default, and D is when the bond defaults for the first time. So the rating D is given to the bond that defaults for the first time, and then recovery, that whatever we recover is lambda of the face value. So if lambda is 40% and the face value is 100, so we are going to get only 40 rupees or $40 per number of bond subscribed or like loan extended to the party. So that's how. Then one more rating that we are going to consider here is E. Why we are considering E is because we are going to solve the matrix of 5 into 5. So we have assigned y, A, B, C, D, and the rating E is when the bond already defaulted in the previous year. So since the bond defaulted in the previous year, so anyway it's going to be in this rating and forever. So forever. So for example, the Reliance case that I was talking about, Reliance Communication, all the bonds of Reliance or the loans Reliance has exposure, they are all in default because it was already default for sometimes from now. So the E for that bond will be 1. So now the next thing that we want to talk about is transition matrix. This is or transition probability for the bond. This is probably let me enlarge it. So this is probably the most important part of the today's session. So what we are going to talk about is the probability that pi AA, pi AB, pi AC, and pi AD, and then 0. 0 is like the last one, which is when I said that. Then pi BA, and then pi CA, and accordingly like this. So the first one, first row is when the rating migrates from A to A, or A to B, or A to C, or A to D, and A to E. A to E is 0 probability because it hasn't defaulted yet. So there is no possibility that it will be in E. The second row starts with B. So pi BEA is the probability that a bond which is in B, rated B, can come to rated A in 1 year. So this is important. So this bond was rated actually B, but it can come to A with this probability. Pi BB is the probability that the bond when it was issued had B probability and it will continue to remain B. Pi BC is the probability that a bond which was at issue was B will migrate to C in 1 year, and this is the probability that the bond B, bond rated B, will migrate to default or will default at the end of 1 year, and this is not possible because since it has not defaulted, so we are not considering B bond to default immediately. So the possibility, this last column will be 0 for this. Then accordingly for the third one, pi C is nothing for bond which is issued at C rating in the very beginning, 0. In 1 year, it can also go 2 notches up to A. In 1 year, it can go to 1 notch above at B. It can remain at C. It can degrade to, can be downgraded to default, and then E is not possible because it is yet in C. So in 1 year, unless it goes to D, it cannot go to it. And the last one is, since the bond is in default, so it gets a 0 rating, and the next rating, the next probability of E going in E is 100%, and a bond which is rated E is also will be rated next year in E. So you get 1 for this. So this is probability matrix. Now you can say this in this matrix, the real matrix, where the same thing that I was telling you, that for example, a bond which is issued A can remain in A. The probability is 97%. So let's see this. This is better where I can put this in. So a bond issued A can remain in A with 97% probability. With 2% probability, it can go to B. With 1% probability, it can go to C. And with 0% probability, it can go to D. Since it cannot go to D, so I will not talk about the E. Bond which is rated B has 5% probability that it can go up to A, 80% probability that it can remain in B, 15% probability that it can be downgraded to C, and 0 probability that it can be downgraded to D. Similarly, the bond C, there is 1% probability that it can be upgraded to A. For example, it gets terrific order, the economy situation changes, and all the cash, there is demand for the product, so the bond can, even the C bond can get into A, but there is very little probability. The next is there is 2% probability that C can go to B, but 75% probability that C will remain the C. So if you can see this 97, 80, 75, as you can see, these numbers are the same rating. So what it means is the rating agencies, when they assign rating to a particular instrument, there is very heavy probability, very large probability that the same rating continues in them, but there is possibility that changing on the situation, the ratings can change. So this is like the most important for our purpose, because we are going to do modeling on the basis of these metrics, which is what we call the transition matrix, the transition probability matrix of ratings. So like, for example, if you are seeing it here, so what this means is a bond which was rated C can move to can be downgraded to default in 1 year with 22% probability. So this is it, and this is how we interpret all these ratings between A to D, and E is for our convenience. So in multi-period transition matrix, what we are going to talk about is the 1 year transition matrix. We call it pi. So this was nothing but pi. This whole thing is pi. This is a matrix for us, for the probability matrix, transition matrix for all this rating. So 2 year, so because this is 1 year transition matrix, so 2 year transition matrix will be given by pi into pi. So you may ask this question, why like we need to multiply this? So the answer is, if the bond A is in A, like the 1 year probability is in A, for the same bond to remain in the second year A, this uh, as you know, probability is multiplicative, because the number of scenarios will increase, and then the probable scenarios will have the limited scope. So we multiply the same by number by the same number. Accordingly, it's possible that the B can migrate to A. So that possibility also we take. There is a possibility that C can migrate to A. So all that probability we take, and then we sum it up, and then we want to know that in year 2, what is it that that we have for the transition matrix for the, because if we are you're looking at the 2 year situation, then in that situation you need to uh, just look at the 2 year matrix, not 1 year metric. So here what we do, like we are going to calculate. So first we select this 5 into 5 arrays. So 1, 2, 3, 4, 5, and then 5 into 5 array. So we select this matrix, and what we do is we use the matrix multiplication formula. So, and the first array is this one, okay, and we multiply this by the same matrix. The one question that you may ask, because in the portfolio management modeling, what we did was we were multiplying one matrix by its transpose. The same thing we are not doing, and the answer is very easy for you to understand, that if a bond A is to be remain in A, so this probability has to multiply. B has to remain in B, so this probability has to multiply. C is to remain in C, so this probability is to multiply. So which is only possible if the same rows, this row is multiplied to this column, and we continue doing summing it up, because there are various situations. A can remain in A, B can come to A, C can come to A, D can come to A, and then so B can remain in B, A can transition to B, C can transition to B, D can transition to B. So like this, all scenarios, which is only possible when we multiply the transition matrix for year 1 with the another year 1, same year 1, and then we get this matrix, and this gives us a probability of the 2-year transition matrix. Now, if we have to do 3-year transition matrix, so this is just simple, because we have already this 2-year transition matrix. So what we do is we write M mult, and then we select this. this 2-year transition matrix, and with this we multiply the 1-year transition matrix, because the same transition matrix is repeating in the 2-year transition matrix. And then we press Control Shift Enter, and then we go and see. Yeah. So, so see the situation. This is very important. Just look at this for your understanding part. This is important. So a bond A, when issued, has 97% probability that in the next year also it will be uh, rated as A. However, from 97 it comes down to 94.2 in the year 2. So in the year 2 there is a probability that there is 3% decline in terms of its being in the same rated A, because the cash flow situation can change and scenarios can be unfavorable for this bond. But then chances of getting into B is higher. Now, if we take the 3-year probability, so in 3 years, the 94% probability of the bond A remaining A comes to 91.5. Why? Because again, as I told you, in the somewhere in the middle of the tenor of the bond, the situations change drastically. Why? Because you don't know how things are going to pan out. Interest rates can increase, which can cost heavy burden on a corporate, and the corporate may not be in a position to like honor the obligation, or the chances are that there is some loss. For example, I don't know whether you guys follow market. So day before yesterday, I think day before yesterday, there was a heavy fire in Deepak Nitrate fertilizers. It's in its
So
factory.
Gujarat plant?
Yeah. And it was shared on the WhatsApp, and like after seeing, I realized that it was no less than a missile attack from Russia to Ukraine, because there were like huge billows of smoke running in the cloud. So 7 persons have been injured. So now what happens? If this is a situation for any company, the most likely outcome is there is going to be problem for the bondholders. Why? Because the factory operations will be stopped for next few weeks or maybe months, unless all the risk systems are installed and all the things are brought back to normal. And because there is no cash flow, so there won't be any payment, and that's why these transition matrices reflect that probability, because the things are uncertain. So like accordingly, if you move from here to here, you see there is a gradual decline in the credit, but in case of like B, it is increasing. So from A to B, there is an increase for the same bond A. So this continues a multi-year. Now, the most important part of this case of ours, mostly in US, some bonds are issued for 30 years. Even in India, I think there are some bonds issued for 30 years, but invariably bonds are issued for a tenure of 10 years. You will always find a bond of 5 to 10 years, always 7 years, 8 years, also possible. But 10, 15 years are also very much in vogue, and that's the central bank of the country keeps on tapping it, like selling it on like either auction basis or like direct intervention in the market. So what will happen, like if we have like something like, let's say we want to a situation of 10 years. So if we have a situation of 10 years and we want to see in 10 years, because you have just subscribed to a bond A because it was promising you a very high return, and then you want to see by the end of 10 years what will be your situation. So here what happens, this simple formula will give you lots of problem, because we cannot continue doing this like more and more many times over. Like once and twice was okay, but multiplying a matrix by itself 2 times, 3 times, 4 times, 5 times becomes a little more cumbersome. So we do what we do is we program it in Excel, and then we call it a matrix power. So here what we're going to do, suppose I have to calculate this transition matrix for 10 years. So again, I will select 5 into 5 array, and I will write here matrix power. Okay. So now once I write matrix power, I have to select first matrix. So I have to select the original matrix. Why? Because this is for the year 0, where I am seeing the probability of transition to 1 year. And then the best part is I want to see the matrix for how many, the transition for how many. So because in our case it's 10, so I'll take 10, and then I will press Control Shift and Enter, and then this has given me the transition metrics for the year 10. So as you can see, the same bond which when issued had a probability of 91% to remain in grade under the same in the same rating of A. There will only be probability of its remaining in A 76% or 77% of the time, but 23.5% of the 23.5% of the time it may go to B, C, or even D, or maybe even E. So, for example, see the fantastic thing here. So, the E rating here, if you can see, the rating E here is 7.06% because this is in fraction. So, if you multiply by 100, it becomes 7.06. So, there is 7.06% probability that this bond had already defaulted in previous years. So, not to talk about year 10, this bond had already defaulted in year 9, and that's why in year 10, its probability to remain in E is 7.06. So this is how, see, the situations have changed. And this is very important. Why? Because if you have to calculate the cash flow in year 10, so then this transition matrix of the probability transition matrix for year 10 is very important, because as I told you, in the beginning, there is no cash flow problem. It's all in the middle. Again, in the last, there is not much of the cash flow issue. Why? Because if a company had issued a bond for 10 years tenor and 9 years have passed, so if a company can manage 9 years of its all payment, I don't think in just 1 year, just 1 year age is going to be getting closer. The company can default. Why? It can still default. Why it won't default is because it had continued making payment for 9 years. So it can always raise further debt and pay back the full obligation and continue remaining in the debt for another 10 years. So that's why the beginning and the last period of a company is not that. So it's in the middle when the credit issue problems occur, and that's when we need to be careful about. So this is the transition matrix. So we'll use, in our case, we'll use this matrix for whenever we want to. Why? Because this is very convenient. We don't need to multiply. It is programmed in the Visual Basic, and it does. Now coming back to the payoff. So we have two situations. Like in case of a bond, we have two situations. Situation one is when we are talking about the payoff before its maturity. So if the maturity is 10 years, so year 1 till 9, we'll only be getting coupon for A, B, and C. For default, you'll only get lambda, which is the recovery percentage. And for E, you'll get nothing. Why? Because the bond already defaulted last year, and probably whatever payment was to be made. So you are not going to get anything. Second situation of payoff is when T equals N. So when T equals N means like bond is at its last year. So it's going to return the principal 1 and plus coupon Q. For B also, it's going to return principal and the coupon. For C also, it's going to return principal and coupon. However, if defaults in the last year, it will only return lambda, which is the recovery that one can get. And like if it had already defaulted in the year before, it's not going to give you anything because it had already defaulted in the last year. Now, this is important, the initial state of the bond. Now, like we have the 5 bond, so A, B, C, D, and E. We have considered these 5 situations, or let's write it in a better way: A, B, C, D, and E. So we have this 5 bond with us, A, B, C, D, E. So if like we are talking about bond A, we are discussing a situation where we are considering the transition of bond A to B, C, and D, and E, and then the probability of its default and the expected payoff that bondholder will get. So then this will be the initial state assigned, like 1 0 0 0. Why? Because what it means is the bond had the initial state of A, and it was not in B, C, D in it. However, if you see this kind of thing, so what it means is the bond was initially B when rated, and then we want to consider what will happen to the bond. If this is the situation, then what it means is the bond was in C, and then we want to see what will happen to its payoff. So these are the initial state. Why this is important? So if you remember, I showed you in the PPT, through PPT, that the expected bond payoff, this initial state is very important. Why? Because depending on the initial state only, we multiply with the transition matrix, and then the matrix, and the probability, and the lambda factor. So then we get to know how much is the payment accruing. So the expected bond payment in period T is, same thing repeated here, is the initial, which is this initial matrix, depending on which bond you are considering, into pi raised to power T. So why T? Because depending on, like, we are considering bond payment in the year 2, 3, 4, or 5, or what. So that is important. And then the last is payoff T. So what is the payoff in T? So payoff before T is this one, and payoff in the year T is this one. So again, while calculating expected bond payoff in a multiplier situation, we'll apply this formula for this for before payoff, before the expiry of the bond, and this is at the expiry of the bond, and beyond expiry, as you know, it will be nothing, zero. So now we go and see one example where we are actually solving this problem. So this problem is, this bond is currently rated B. So because this bond is rated B, so its initial state will be this one, 0, 1, and 000. The bond has 5 years to maturity. So the tenor has become 5 years. The bond's current market price is 100% of its face value. So if the face value is 1, so it is also priced at 1. The bond's recovery percentage, lambda, is 50%. So this is important. So in case the bond defaults, so then only 50% of the payment can be recovered from the bond. So this is a situation under which we are going to calculate the payoff under various scenarios. So we write these 5 things, like bond price, which is the face value 1. The coupon rate is given 7%. Recovery rate is given 5%, which is 50%, so 0.5. Bond tenor is 5 years, so we have taken this 5. Initial rating is B. So because initial rating is B, so initial matrix that we'll use, initial state of the bond we'll use is this one, and which is what we are going to show you there. And then the 2 columns we also create. Why these 2 columns are important? Because the payoff for a bond will depend on whether it is the bonds the last year to maturity or before last year to maturity. So prior to maturity, we get for bond A 0.07, 7%, 7%, 7%, and then 50% of the face value in case default, and nothing in case it is A. However, if it is the last year, then we get 107%, 107% for B also, 107% for C also, and 50% for D in case it defaults, and then 0 if it was already default last year. So this is there are 2 payoff situations. So we can call it this payoff 1 also. So we can also call it payoff 1, and we can call it payoff 2. Now, this is the transition matrix given to us. So this is the same transition matrix which we used. So 97%, 2%, 1%, and then this 22% from C to D. So this is the same transition matrix. Now, this initial vector that we are using, because bond was not rated A, so for A we have used 0. Bond is rated B, so for B we have used 1. Bond is not rated C, so we have used 0. Bond was not rated D in the beginning, so it's 0. And because it's not D, so it cannot be E also, so it's 0. So we have this initial vector 0, 1, 0. Why we are using these vectors is because we are not going to calculate payoff for bond A. We are going to calculate payoff only for bond B. So it should not occur that while we are multiplying using matrix multiplication, we also get payment for bond A, which is not the situation. Now we have this situation. So we we are taking a situation of 10 years. Why 10 years? You may ask that because the tenor is only 5 years, but why 10 years? And in fact, like you can go for 20 or 30 years also, is because it's possible that the case of Reliance, as I was referring to, it's very close to its settlement with the counterparty, and the counterparties are close to settling the term of the restructuring, where it's likely that it will restructure. So even if the tenor of the bond is 5 years, it's possible that in the year 9th and 10th, there can be some payment possible depending on the situation. So we want to draw a situation for 10 years. So now what happens is in the year 0, we have the expected payment of -1. Why? Because we are first paying it 100% of the face value, and then we are calculating uh, we are calculating the payoff in the next year. So we write for the year 5 to 10, we write a formula separately, and then we for year 1 to 4 we write a formula separately. Why we are doing it is because for year 1 to 4 the payment is different, payoff is different. Year 5 the payment is different, and year 6 and on, as we know, is basically there's nothing left, but it's still possible that, like depending on various situations, a bond can pay you after many years have passed by from the date of its last term or its tenure. So we use the formula called if. Why? Because we are uh, getting into a situation where we don't know whether the bond is going to be in the year like 5, 6, or 7 or more. So then I select the year. So I select this entire year 5, 6, 7, 9, 10. And then so I've selected for all this 5, 6 to 10, and then I enter greater than, because we have this situation that if this is greater than the bond term. So what is the bond term? Bond term is 5. Bond term is 5. So if the year 5 to 10 is greater than this bond term, then the payment, then the value that we want is 0. In other situation, then what is the alternate situation? So alternate situation is again if I select the entire year, so G1, this is G, A, B, C, D, G, yeah. So G1 to 9, to sorry, L1 to 9. Here I will write equals. Why? Because the greater things I have taken into consideration, but here I'm writing equals this. Okay. And then what is the situation? So if this is a situation, then I want the matrix multiplication, because in that situation my payment will only be possible if I multiply these 3 matrices, which is what we discussed. So the first thing is initial vector as per the formula. So I take this matrix multiplication of this initial, and because we are going to have the 3 matrices, so we are going to use another matrix multiplication, and then I'm going to use the matrix power. Why? Because I need the transition matrix for year 5. So I use the term matrix power, and then I select this matrix. I select this matrix, and then I write 5 because I want it for year 5. I want it for year 5. I can also take the entire matrix. I think that shouldn't be a problem, but I can let it be 5, and then I close this. I close this. Then I multiply this, which is the more important is with this payoff, because I will get this payoff, which is where it is important. And then like I close all the brackets. So then I will have to calculate how many brackets I have entered. So let me see, 1, 2. So maybe I have entered 3. So I need to enter 3. So then I use the control shift and enter. Okay, so I think I need one more bracket. So I have accepted that, and I got this payment of the 88% of the face value, which is like I paid 1. So in the year 5, I'm likely to get 88% of the face value, but year 6, 7, 8, 9, 10, as you can see, I'm getting 0 because the bond term is expiring, and that's how it is programmed. So now the next thing that is important is for the year 1 to 5. So so remember, like in year 1, there is very little that this bond will default, because as you can see, the bond is rated B, and 80% chance that it will remain in B, 15% chance that it will remain in C. So 95% it will not be defaulting. Okay, and even 5% chance that it can go to A also. So the chances that it's not going to default. So that's why the payment for this is important. So here what happens here, I will use the term matrix multiplication for this matrix multiplication, and what we need is the initial vector. As you know, we have always been using this initial. So this initial, and then we multiply with again matrix multiplication, and then we go to matrix power, because we uh, have the uh, different power for different ones. So that's why we are programming it in different way. So so matrix power, and then I select this one. And here there is a catch. There is slight thing that is important is I am going to use the cell for the year 1. I'm going to use C, and this will be 129, I think. Yeah, C129. So I'll be using C129. So this is for the year 1, and then I close this. Then the third matrix that I have to multiply, and that is what is the payment. So as you know, the payment is going to be this one, because this is less than, I'm calculating this for year 1 to 4. So this is less than the term of the bond, which is 5 years. So for 5 years, I have used this payoff. For less than 5 years, I have used this payoff. So yeah, so then I can close this, and I can close this, and then I think I'm done. Yeah, so then if I use control shift and enter, then I get this value 0.07. So in the year 7, in the year 1, I'm going to get the 7 rupees for 1 rupee. Sorry, for 100 rupees invested, I'm going to get 7 rupees. So likewise for 2, 3, 4, I can calculate. But because for 2, 3, again, writing this kind of formula is very cumbersome. So we'll just modify this formula in such a way that if I copy and paste the rest of the cells, it will give you. So if you can see this over here, as you can see it here, so what you are saying is everything is changing here except everything is the same except this year. For example, for the cell 2, the value of the year will be different, but all other formula will remain the same. For cell 3 value, only the year term will be changing, but all the initial vector, the transition matrix, and the payoff matrix of this will remain the same. So all I need to do for this case is like just to use the dollar term wherever I am comfortable. So I keep using dollar term for wherever, like I think is the same thing getting repeated. So I change it to dollar except C129. I'm just like, no, C, I don't want dollar because then it will, and then for this term, I want dollar. So yeah, and for this term also I want dollar. Yeah. So I'm done for this, and then I use Control Shift and Enter, and it gives me the same value. But then the advantage of this, I can copy this formula, and then if I drag it down and paste it, so I get the different values for year 2, year 3, and so what it is happening here, it is in the cell in the year 2, the expected payoff is depending on the matrix power of 2. So it's multiplying matrix with the same matrix. In the year 3, matrix power gets to year 3 power 3, and in year 4 it gets to power 4. So as you can see, so we get almost $7 per $100 invested, $8.4, $8.9, and $8.9, maybe $9 in the year 4, and then $88 in the year 5, and this is the expected. Now, if this is the condition, then what is the IRR? Because you need to know the IRR. So as you know, the IRR formula is very simple. So all you need to do is to select all these values. IRR is the simplest way to calculate, and it's asking you to guess, but I don't want to guess. So I just press enter, and then I hit enter. Oh, what went wrong? So IRR C130, 12,130, C130, 12,130, L130. Fine. So why should be problem? Okay, maybe I pressed. IRR. Oh my God, how can I do this mistake? So this, if this is not taken, the initial negative value is not taken, it cannot calculate IRR. I'm just taking the payoff that I'm receiving, and I was just crazy. So the -1 value was omitted from the cell 1 was omitted, and then I don't want to guess, and then I press enter, and I get 4.61% as. So there was mistake previously. This one was not included. So in IRR calculation, you need to assign both the outflows and inflows. So you get the 4.61%. Now, assuming that like we create another data table, depending on a situation where the recovery percentage are different from the 40%, the 50% which we calculated. If the recovery percentage is 0% or 10%, 20%, or maybe 90%, what will be the IR? So we have this situation. So we have created data table just on the basis of the same. If we change the lambda, the IRR will change, because depending on lambda, the metrics will change, and because the payment will change. So we get this. So this we can take it to the a graph where we can show that, like, if depending on the recovery percentage, how is our IRR going to change, and with that IRR, whether I'm comfortable investing in a particular bond. So the next thing that we can talk about collateralized debt obligation, but before this, CDO, let me finish something about the modeling part of this, the credit. So let's go to the let me stop sharing this. Okay, so okay, so we want to do the risk modeling in a situation where we are not talking about a particular bond for many years. We are talking about many bonds that a corporation can hold or an investor can hold, or many loan portfolio that a corporation can have, and then it wants to know what will be the situation if it has this kind of portfolio. So so what we do is, so uh, so let's define what credit risk we are talking about. So credit risk, as you know, is a situation when there is a problem in repayment of either coupon or the principal amount, and that all depends on a particular property situation, scenario, or like circumstances surrounding uh, a particular debtor or yeah, a particular debt holder, borrower. So what we do is, we in this modeling, we can split this portfolio of credit risk into 4 steps, and this is important. These 4 steps are very, very important. So in the first step, what we do is we specify probabilities for individual credit events. So for example, what is the probability that the Deepak fertilizer that had fire in its factory a few days back will default for the next coupon payment due in 1 month or 2 months? And then if you look at his bank balances and see the situation, so you can say that very little chance, maybe 1% or 2%, because the near term there is no problem, but maybe 2 years or 3 years down the line, if this problem continues, then there is an issue. So this is how you specify probability of individual credit events. There are certain econometrics tools, for example, logic regression, through which you can also get to know the probability of default, because that also takes into account various parameters like age, or the cash flow, or the assets, or the it can take any number of inputs and then give you the individual credit events and the probability of individual credit event. The second thing that we do in that situation is we calculate LGD, loss given default. So in case default happens, though there is very little probability, but if default happens, then how much is the loss going to be? So for example, uh, the losses could be 1%, 2%, 3%, because you may not have all your uh, loan going bad. So you may have only like the portion of it going bad, because the chances that the assets of the debtor will be sufficient to pay off the obligation. So only some portion of that. So loss given default is the percentage loss that will happen in case there is a credit event. So for example, if like my borrower is 100, but like it has zero asset, so my loss given default is 100%. But however, it has 90% of the assets, like if it has an asset that can satisfy 90% of debt obligation, so the loss only will be 10%. So the LGD will be 10%. Then third thing that we want to specify is, that is very, very important, and which is where this modeling is all about, using the models, advanced models, to calculate the credit risk. We specify correlations of individual credit events and value effects. So what happens is, so like for example, see, if A is to make payment to B, but A is to receive payment from C. If C defaults, then A will default, and then only B will not receive. So we need to see what is the correlation between different events. What is the correlation? So for example, is it possible that B, C also doesn't default, but B also defaults. So those things are possible. So we take correlation into account. And for this correlation, we take a factor called WI, which is what I'm going to show you in the next slide, that how we use this uh, mm, uh, yeah, to calculate the loss in a situation where we are doing modeling of the credit risk. So, so the most important part in credit risk is a borrower I means 1, 2, 3. As a banker, I may have hundreds of borrowers. So borrower I can default only when its asset value falls below some threshold DI. Borrower I can only default if its asset value uh, falls below a threshold D. D I call it default or debt. So if its assets falls below the debt, the present value of the debt, then only it is in default. However, if the assets are still more than the debt, so still there is some equities or some net worth left in the company, and that's why there is no need to worry. So, so so on that specified probability, we need to know what is the DI, and then based on that DI, whether the company is going to default. So moving to next. So this first situation is, as you can see, the very first thing, default happens when AI, that is assets of a particular company or a particular borrower I, is less than that the debt that it has issued, less than or equal to the DI. So this situation is very important. So if the assets of the borrower falls below the threshold of debt, then only there is a default. Otherwise, there is no default. So the no default situation, as you can see, as long as the borrower's asset at the end of the horizon, like 1 year, 6 months, 2 years, 3 years, 5 years, is greater than the debt payment that it needs to meet its obligation, so there is no default. So we are in two situations, 0 and 1. Default when asset value falls below the debt level, no default when asset value is above the critical value of the debt or the threshold value of the debt. So in this modeling, which is what we are going to do, the important thing is we are assuming that the asset value are assumed to be normally distributed. In fact, a standard normally distributed. The difference between normal and standard normal, all of you know. So no need to emphasize on that. So this value are assumed to be a standard normally distributed. So then what we do, we set di equals to the phi inverse of phi. Phi is the cumulative probability distribution, and then take the value of PDI. For each PD, for each probability of default, we calculate DI value. This is very important. This is very important. So if you calculate DI for each this uh, PDI, then you will get various DI under various situations. And this is what we are going to do, because we are doing a modeling. So we need hundreds and thousands of those situations. And then we want to calculate the different values of D1, and then based on that different values of A1, and then the loss data and things like that. So our model gives us this value. Asset I at time I, or like for a borrower I, equals Wi plus Wi into Z plus a square root of 1 minus Wi square into epsilon I. This is important. This you have to remember and memorize, that in this credit asset value approach to credit modeling, the value of an asset is depending on the Wi factor, the factor Z, and the epsilon, which is unsystematic. So there are three factors here. One is Wi, which we assign on the basis of probability. So we'll assign, we can assign that what is like how is it that these my loan assets are correlated with the other assets, and then what should I assign this Wi to be. So Wi can be anything from 0.1 to 0.9, and Z is, as you know, this standard normal distribution factor. So Z, we take it from the model, which will show you how we are going to use Z in our model. And then the whatever Wi we take, square root of 1 minus Wi square, we multiply with a random variable, because epsilon is, as you can see, the covariance of epsilon I and epsilon j is 0 for all I, for I not equals to j. So it means like these error terms or the non-systematic terms, which is like asset value keep on fluctuating from year after year. So the non-systematic part of the asset value is like has this stochastic element, which is what we are assigning it. And then the covariance between the z, which is systematic factor, and then the epsilon is 0. This is important for all I. So this term is important. And then the z is normally distributed with 0 and 1 parameter, and epsilon also normally distributed with the uh, mean 0 and variance 1. So this is the model on which we are going to do now a simulation. So let's see what we need to know before we move to the Excel. So we have assumed here that the systematic Z and idiosyncratic shocks are independent, and obviously it will be independent. Why? Because systematic factor will be dependent on the economy. So if there is like if GDP is growing, so Z will grow. But it's still possible that GDP is growing, but the particular the asset of a company decline because of some idiosyncratic like fire. Fire has nothing to do with the GDP. So that's why these things are independent. Next is in the asset value approach, the what we do is we run a Monte Carlo simulation. So all of you are aware, you have done it many times, but we'll do it once more. So we do it, we run it a simulation on the basis of all the parameters that we have devised, and then we calculate the loss data, and then we see if we have the thousands of iteration like this, or maybe 5,000 or 10,000, what is the maximum loss that the portfolio can have, and like in normal situation, what is the loss that we can have. So what we do, we do three things. One is we randomly draw asset value for each obliger in the portfolio. So we randomly take the value of Z, which is what like I'm going to show you in the Excel. And then the next thing that we want to check is whether it has defaulted. Why? Because the default will only happen if the loss given default and the exposure at default. These two things are important. See, loss given default is a percentage term, and exposure is how much we are exposed to this particular company. So the overall loss will be this. You cannot have loss more than this because loss given default is given, and then your exposure is given. So you can have only the maximum loss of LGD into EAD, but this can only happen if your asset value is more than DI. If the asset value less than DI, if the asset value is more than DI, the minimum debt value that you need, so there is no default, there is no loss, and the loss value becomes 0. So between these two extremes, we'll keep on toggling. And then what we do, we aggregate the individual losses into portfolio loss. So because we are running multiple situation, multiple scenarios, so what will happen is we will aggregate all these individual losses, and then we'll see like how much loss we can have under different scenarios. So the next the last one thing that is left is we so that we have estimates of the asset correlation, which is what I said that depending on the asset correlation also we assign a parameter WI, and we use a one factor model with normally distributed asset value. So correlations are fully specified once we have specified the factor sensitivity WI. So with this, let's go to the Excel, and let's look at the simulation part of this like a large loan portfolio where you have hundreds of loans or thousands of loans, and you have different scenarios of probability of default, or like the loss given defaults, exposures, and WI. So let me minimize this. So okay, so Yeah, so we are there. Okay. So yeah, so we are in a situation where we are conducting a simulation of loan portfolio of a particular creditor. So as you can see in this column, there are different loans. So I have taken only 109 loans. This can be taken to 1000 or 5000. Like you can always extend it, but I wanted it to be like easier for you to understand. So I have kept this the number of portfolio is small, but you can with this small portfolio, so you can run many trials. That's not a problem. Then probability of default we have assigned from 1% to 5% because we don't think that when the PD is higher, then you need to calculate that situation because if the PD is higher, most likely the default will be there and then it will be higher. So a prudent bank will not like to be in a situation where the default probability is very, very high. The loss given default, we have taken a standard 50%. So we are assuming the respective of whichever credit event happens, there will be 50% loss in case there is a default by the company. Now that default probability will change, but if case the default happens, then there's 50% loss. And then in column D, we are writing EAD. So but EAD is nothing but exposure, the uh, exposure at default. EAD is exposure at default. So for example, if 100 crore loan is given and 50% is the chance of default. So if the default at all happens, there will be 50 crore loss that will happen. So and then the next thing that we have assigned, is uh, is W. So W is 0.3, as I told you. The 0.3 we have assigned. Why? Because we have taken the correlation into account, and we have in our model we have taken W as 0.3 because in our model this suits, but you can take 0.4 also, 0.5 also, which is possible depending on the correlation. But 0.3 is a good term to start with. Now, as you can see, there is a column called default threshold. Here, there is a column called default threshold. So how do we calculate default threshold? This is important. So how do we calculate default threshold? Every time I'm writing, it's changing. I'll show you why it's changing. So for this default threshold, what I'm going to use is very simple. So I write norm as inverse. So this, and because my probability of default is 1%, so on this I want to know what is my threshold at which I will default, and it gives me 2 minus 2.33. So this is how I have calculated a default threshold for all like probability. If the probability is let's say probability is 3%, so and then if I write 0.03 here, I get minus 1.88, which is what, if you can see, is the value here, minus 1.88. Okay. And accordingly, if I want to know the 5% the default threshold, so I write 5% and then I enter. So I get these values. So my all default threshold uh, values are moving because of the probability. So default threshold is changing because there are different probability assigned in the loan, and that's why there is a different default threshold. So the next factor that is important is factor Z. So how do I calculate factor Z? So factor Z, so like factor Z. So how do I calculate factor Z? So factor Z is just the other way around. So we have assumed that we have a normally distributed asset. So even the random factor that we want to select for Z should be a standard normally distributed. So we'll write here norm S inverse, and we write rand because we want random number, and we open and close bracket because we want any random number between 0 to 1, which is what Excel shows you, and then we press enter. So I get this factor Z as 0. Minus 0.83584, and as you can see, this here is different. Why? Because this is changing, because this is a random number which keeps on changing. So the next thing that we want to know about is asset value. So the next thing that we want to know about is asset value. So how do you calculate the asset value? So as you can, so as you know, the asset value is nothing but it's a possibility of how much you according to your model AI, well, like which I showed you, AI equals Wi into Z plus a square root of 1 minus Wi square into epsilon, which is again like a random number. So this asset value will be calculated according to that. So we need to program it accordingly. So I write it this W, where is W? This into this factor called Z, this Z, which is J10. Yeah. So Z10, E10 into Z10, and plus 1 minus Wi square. So I take a bracket. And write 1, then minus, then this one, and I want this one power square, this 2. Then after I close this, I want this to be a square root, so I can make it 0.5 rather than writing SQRT. I could have written SQRT and it would have given the same value, but writing power is easier in Excel, the power factor. And then the next important thing is I want epsilon value. So this is important. So because epsilon value is a random, but it should be from normal distributed factor. So I want a random for this, again this and this. Then I close this and I press enter. So I get this value. Okay. So my asset value has become this. My factor I calculated like this. My default I've calculated this. Now the next important thing, which is a loss per loan, which is important. So how do I calculate loss per loan? Remember, loss can only happen if this value, which is this, is lower than this. So I just need to write a simple thing, like if this is greater than this, then so as you can see, I have just multiplied this C10 into D10. So for loss, what I'm doing is I'm multiplying C10, which is LGD, into D10 100. So anyway, my loss is going to be 50. But then I'm attaching a condition which is similar to if condition is H10 should be less than G10. Why? Because if asset value this is less than this, then only there is default. But as long as this is more, so there is no default. Now, where is the default? So just let me see where is the default. So as you can see, the case this 51, the case 50. So your asset value is minus 1.93, and your D1 is minus 1.75. So you have exceeded that. You have exceeded that threshold, and that's why that's why like you are in default, and since the default is happening, so the only default that is happening is the 50, because there is no way that it can happen less than that or more than that, because you know that 50% can be recovered. Similarly, if you go further down, I think there is one more portfolio where there is a 50 loss. Yeah, so there is one more portfolio, a scenario where this the factor z value that we have calculated based on the randomized normally distributed variable is less than the threshold value, and then the default is happening, and default is happening, then it's a 50. Now coming to the last part of this simulation. Now the last part of the simulation, as you can see, the saved portfolio loss. I've created a column called saved portfolio loss. So this is 100. So what is this? So if you can say, this is nothing but sum total of all this. Like if I sum it all, yeah. So as you can see, the loss is 100. The loss is 100, which is what it is showing me here. The third portfolio, the first part, and even the second part, portfolio loss. So one good thing here is, like, let me keep my cursor here and let me press F9. So if I press 9, this portfolio loss has changed, and that's why this first value, because first value is just this value only, nothing but this value. So this 200 is the loss. So this is coming because there is possibility that there are 4 times out of this 123, there is 4 times 50-50 losses, and that's why you are seeing this situation. So what I have done here in the safe portfolio, I have run multiple iterations and I have calculated what is the portfolio loss. So there are occasions when there is 250, there are occasions when there are 300 losses, there are occasions when the overall losses under this thousands of scenario 450, and in some situation as losses are as high as 150, but they will be very few. Why? Because if I take it to this confidence interval and percentile calculation, I will show you this soon. So that's a very little possibility, but there is 1% is still probable that you can have, like, out of this 1000 situation, you can have the multiple losses, and all losses can exceed much more than what is your exposure. So and mostly between 0 to like 50, 100, 200 is, if you can see, all these are multiple of 50, 0 and 50 or 100, it multiplies by a factor of 50 and then keeps on changing. So this is just taking from every iteration. So if I keep on pressing enter or like F9, so this one will keep on changing. If I keep on pressing F9, it will keep on changing on my portfolio. So there is a situation when out of 109 situation, there is absolutely no loss. So that also is a possibility. Then almost in all the situations, like that we have run into, there is no loss, so which is possible. Now, so if we have this different confidence intervals like 90%, 95%, 99%, or 99.9%, we would like to know that what is the percentile value. What is the percentile value where we can see that the loss is exceeding beyond that and below that. So we have used a formula called percentile, and we have selected this entire K. This entire K we have selected. Why? Because we want to know that how these values are distributed, in which like portion of the distribution it will fall, and then we have calculated. So as you can see, we have calculated, and we have calculated with this individual probability with the confidence interval of 90% for this, for 95% and 99%. So yeah, like in 99% of situation, the value 99% confidence if you take, so it may not exceed 791, maximum 791 it can go, but that too is very rare. So, and like almost 100% of this distribution is captured, so 100 at 45, which is what like this value at 50 is in a way showing you. So this is how we do this. and we can also program it in VBA. And if we program it in VBA, we don't need to do this in separately. It just all the just you like enter a particular iteration trial, and then you press hit, and then it takes a certain time iteration, and maybe depending on 4 minutes, 5 minutes, depending on what system you are running, it will show you. So this is how we do the credit loss model, and this is how actually in organizations also the banks do, or the various models that are built into that are proprietary developed. They do all these things, and they get to know how much is the loss happening under various scenarios. So this is about it. The last part that I want to discuss is again the option the way of valuation of the debt, the modern model of the debt valuation. So which is important. Why? Because you can look at a debt as like an option given to the equity holder. So let me again share the PPT, and the PPT is yeah. Yeah, so in this last part of the credit modeling, we do the structure model. So basically, there are two ways uh, the credit risk models are done: a structure model and reduced form model. So in a structure model, which is what we are going to do, is we try to model the assets and liability of the company using probability of default. And you saw this, like we used PD, we used loss given default, and we used exposure at default. But here what we are going to do is we are going to use option analogy of the credit risk. Why? Because we believe that a company has a mix of debt and equity. So the moment the value of the asset is more than the value of the debt, so there is a value of equity. And so in a way, there is an option written on the asset of the company by this the bondholders. So they have given this option to the equity holders. So if the asset increases in value, the equity holders encash that value. If it decreases in value, they forfeit their claim, and the residual or the whatever is left over is reorganized and paid back to the creditors. So as you know, the payoff from a call option on a stock is maximum of stock price minus exercise price. We have done it in Excel. So same way we do it over here. And similar way, a limited liability can be seen in the financial of a company. So if you have seen that if the asset falls below DI, so the equity holders don't get anything. So coming to this, the BSM formula application in the debt. So if the asset value is more than the present value of the debt, or the face value of the debt, then what the equity holders received is 80 minus X. Why? Because this is the residual claim. Equity is supposed to be residual claim. So Black-Scholes, if we use Black-Scholes model to model the risk of a debt portfolio, then we have to assume that the stock prices follow a stochastic process. So stochastic means it's like uncertain. So it's a random walk. So it can continue following that walk, and we don't know what it is. So what we write as equity value is the AT, which is the value of the assets of a company at time t, into ND1 minus X into exponential minus RT minus 2 into N2. So this formula is well known to you, and so there is no need to repeat. D1 also, as you know, that you are aware of this, and D2 is nothing but D1 minus sigma into square root of the time left over. So if like the bond is for time period T, and out of which the small t has elapsed, so what is left is T minus T, and that's why we use this term. So coming to the valuation of debt. So for valuation of debt, what is used is the values of the asset at time t, into n minus d1. So this is where the value of debt is different from the option value, and plus x, which is the face value of the debt into exponential minus rt minus t into n dv. So as you know, the first term, which is the asset multiplied with n minus d1, this is the present value of the payoff if the default happens. So in case default happens, only this much will be the payoff, because there will not enough to pay to the creditors. However, if there no default happens, then what you get is the discounted value of this, which is what the debt value is. So, how do you calculate the probability of default? So you calculate probability of default when AT is less than X is 1 minus probability AT is greater than X. So we call it E2. So what we call it is NE2. So 1 minus NE2, as you know, will become N minus E2. So now you might ask that we were using D2, and how come we have used this term E2? So here what is happening, that in case of Black-Scholes, we are assuming that it was not dividend paying. Whereas in case of a company, the company has a certain percentage of the average return, and which will anyway it will generate that much return and probably pay the dividend in that way. So the E2 factor will change because of this, the expected return, and then the time left for the payment of that. So then we calculate E2 as log asset value upon X, the similar way in which we use the D2 and D1 for Black-Scholes. And but this term is different in this case, and the rest all is same. And then what happens is, like, as you know, if you know the E1, so you calculate E2 similar way. And then finally, the last term that we do here in this, the expected loss that we calculate using this, the option modeling of the credit risk, is the face value of the bond or the loan amount we multiply with the n minus E2, and then from there we subtract the asset value, the present value of the asset, and then multiply that with the probability, the n minus E1. So this becomes our expected loss, very similar to what we do in case of option. And then if you have to calculate the present value of the expected loss, so we just like discount it by the exponential term, whatever time is left. And then, as you can see, is like this is just a discounted value of the same factor. So this is how so the same thing what we are doing it is can be taken to the option pricing model, where we calculated these values, and we can calculate this, because in, if you know how to do the D1, D2 in Black-Scholes, so similar way you can calculate this. So there is nothing much to do under this. If you know the Black-Scholes, and if you know D1, D2, and exercise and the sigma and all that. So one thing that remains again is, like, I wanted to ask you guys one thing and then explain it in case because this is something that is also in. So let me. Yeah. Yeah. So there is something called collateralized debt obligation. So this is this is part of your syllabus, and you need to know what this is. And unless you know this, the modeling for this will become different. Once you know what CDO is, then you can model it very easily, because you know the analytics, how analytics are used for modeling a situation, a scenario. But you need to understand what is CDO. So I think I should explain it in a very simple way. So let me take a situation where a particular bank has extended uh, a loan of 100 crore to borrowers at 16% credit. What will happen is, every year it will receive 16 crore as interest payment, every year it will receive 16% interest payment. As you can see, this 16% is very high figure. Normally, if you go to a bank and you want to borrow anything like this, so 12% probably will be maximum, or in current circumstances, maybe housing loan you can get for 7, or this consumer loan you can get for something like 10. Even for something like very risky, like you have some export import, for that also I think you can get for 12. But the fact that this loan is issued 60%, what does it speak? So it speaks that the credit quality is not good. So credit quality is not good. So what does credit quality mean? So possible that either it is double B or maybe just B. Just B. Just B. Now, so what happens, like if loans of these things are issued? See, all the financial engineering in the world, all the financial engineering in the world is actually the handiwork or the brain work or the imagination of the very rich and smart people like hedge funds or the merchant bankers. So, for example, if 16%, if a bank is getting 16%, is it possible that I get 16% or maybe I get 18% or 20%? If I ask the question, if the bank is only getting 16%, is it possible that I can get 18% return without even like giving the loan? The answer is yes. And how does it happen? It happens through CDUs. So what happens is CDUs, in case of CDUs, that this 100 crore loan of 60% is sold to a third party, which you must be knowing is a SPV, and then the different tranches of that is created. So let's say 30 crores of this is created in one tranche, 40 crores are created in another tranche, 20 in another tranche, and 10 is another tranche. And what happens is, like, I give double A rating to this. This is possible. I give A rating to this. Maybe this is not rated. Maybe this is not rated, also possible. And this is equity tranche. I call it equity tranche. So I get this equity tranche. And then what happens is, because these loans I have repackaged. So how is it possible that I've got this 30 crores or 30% of the loan as double A, 40% as A, and this is not rated, or maybe it can be rated B also, which is possible, or double B. So how is it possible? So what happens in any loan? It's not possible to have all the borrowers very bad. So for example, these loans, kinds of loans are extended to rickshaw owners, daily wage earners, or the factory workers who are just like on not the payrolls but daily wage earners. But still, some of them will be very decent, come from a very good family. They might be paying very well, and their credit history is good. So what happens if these, out of those payments are passed on to these the 30% of the bond holders, and then they are made a promise of what, like 8%. So what happens is 30 into 8, so 2.4, right? 8%. 8.
So you need to turn the percentage sign on.
Yeah. No, that's okay. Yeah, that's understandable. It's a small amount. So this so accordingly, yeah. So what happens is, and this 40% is promised a payment of 10%. So this 40% gets 4. Just assume that there is a default like this. So If all the borrowers pay, then there is 16. However, if only 50% of the borrowers pay, then this amount will be 8. Right. Now see the situation. So if I drag it down further, so how much, if I take the sum of this, how much will it come? 8.8. So obviously what will happen is uh, this particular tranche, which is like not rated, cannot get 12% the full payment. So this will have to satisfy with whatever is left, and then that will be paid to this borrower, because after paying 6.4, the only 1.6 crore or 1.6 amount is left for the not 20% of the borrower. And then in that situation, what will happen is the rest money will be paid to the not rated borrower or the triple B or double B rated borrower. Now, assuming that the entire 16 loan is returned, then what will happen? How much this equity holders will get? So he will get this 16 minus the sum of all this, and then he gets 7.2. So from just investing 10, and he's getting 7 points. So this is awesome return. So the return is, just imagine how much is the return. Yeah, so 72%. So as you know, depending on the situation that we have, this CDO behaves in a very different situation. Now, the most important part of this CDO is this planning about this equity tranche, because the equity tranche, for the person of equity tranche, it's very important that it models this in such a way that he knows it, that what is going to be the default, and if there is a default, then what is going to be this payment, and if this payment is going to be, where is the return, then whether he should invest or not. So this is all about the default obligation. So in the CDO is all about investing, those people who invest a little bit of money, but they made huge amount of money, but they also lose. These are the first people who are on the line of like the last line on the line of the receiver end. They will receive nothing in case there is default. This person also will receive get the least priority. This will get medium priority, and this person will get the highest priority. And that's why, because this has the highest priority, that's why the payment rate is the interest rate is low, but the number of the investors are also low. So this is all about CDO. So if you have to do modeling of CDO, all you need to do is to model these scenarios, that what is going to be the default based on the economics. So you have to basically model this, okay, which is what we did. And if you do this, so then what will happen is this value will change depending on how the situation, and if this value changes, so automatically this value will change, because this value is fully dependent on the payment made to this and this. So this is how we look into the CDO obligations, and that's all about the credit part. Let me see check. Yeah. So what are the, if any things are left? So yeah. So you have in your syllabus like things like weather derivatives, environment derivatives. These are all simple derivatives where there is nothing much to use except the concepts employed therein. So for example, in weather derivatives, you take certain parameters like temperature, and then you, or the rainfall, or the use of electricity, or the production of gases, or like the crude, and all those things are multiplied with certain factors. So basically they are all like customized derivatives where you have the payment depending on the maximum value of the underlying reaching a certain value, and what exercise value is agreed. So these are mostly OTC derivatives, because not many of them are traded in the exchanges, but some of them are also traded on exchanges. So that, and then the almost rest all things are covered. So let me like give you a few hint about, like in case like we set some question. So what you need to look into the paper. So this uh, if you remember, this was like the black letterman was explained to you. So black letterman you should pay attention to. That's very important, because if you don't know black letterman, I think the purpose of understanding modeling is gone. There is no point. And then in option valuation, both you should know how to use the binomial valuation in case of one, two, or multi-period. So multi-period we use VVA. So in case multi-periods are used, use VVA formula. If one or two are used, so you just use the simple binomial model. And for Black-Scholes also, like D1, D2, you should know how to calculate. Then the implied volatility you should know how to calculate, and then the value of the call and puts. If one of them is given, so you can use put call parity also, and you can calculate that. So this Black-Scholes model is again important. And in case of option Greeks, the basic one like delta and gamma, uh, like you should know how to calculate with that directly or with Excel, like with the VBA. And in case of the bond, the you should know if the payments are uneven, like the payments are not happening regularly, like yearly. So part payment, like only like you have bought a bond and the next coupon is due 3 months from now. So you should be able to calculate the NPV and IRR in that situation, because that's why it's important. Because in real time in the market, nothing happens perfectly. So many things happen like every day, and that's why the valuation at that moment is important. And for that, you need to do this XIRR NPV in those situations. So that's how you will be required to do. And then the value at risk is also important, in the sense that you like threshold value you can calculate, or like you need to tell that what is the cumulative probability of this value at risk, or like the if you have to draw that situation also. So that, so just like just like look into these things. And in modeling, especially using Excel, if you are not practicing, it's not going to work. So like if you stop practicing and you think that because you're using other analytics technique, it's not going to work. Why? Because like I'm seeing, I have started using Office 11, Windows 11. So Windows 11 has certain like better feature than the Windows 10 had provided. So how it is different is, so for example, for many of the formula you write equals and then you multiply. But in the latest version, even if you don't write, and if you are multiplying two cells, it takes that value. So this is why it is very important that if you are doing modeling in Excel, that you should update yourself with the latest the version. If you are not using it, then what chances are that you are writing the correct formula, but it's not working for you. Why? Because the latest in the latest feature, many things are like made very simpler, very simpler. I'm seeing that many things have been simplified to such an extent that what we were doing 4 years, 5 years back, like was more challenging. Today it is like much easier. So if you stop practicing, it's going to be a problem. So with this, I will stop. If you have any other query that you want to ask, you may ask me. What I will say, do that some of the files that like I prepared in the process, I will share with you, and I will also share one important book, because I understand. I don't know whether you have ever this the modeling of the debt, which we have talked about. So modeling of the credit is very important. If you don't have the fair understanding of the credit side of the market, then doing that simulation and bootstrapping of that will be a little difficult. Why? Because uh, there are many nuances. So we covered only part, but because that much only was required. But you need to go through the book to understand the whole the credit the credit modeling, either using Excel or like other way around. So I'll share some literature on that, and then some text also on that. So you can use that and keep practicing this. If you keep practicing, I don't think it's difficult. some of the times it creates problem, but with some amount of time you develop your own techniques of doing things. Many times I find that certain formula doesn't work. Some formula like should work, but it doesn't work. So then I go back and think from that side, and like I look from a different angle, and it works. So it's all possible that if you can program like gradually, and you can do it, and that's how it is to be done. So with this, I stop, and some of you who have like just like wrote to me mails, I will get back to you on that. Or like my number is with most of you. In case you want to get in touch with me. So even if like we are not communicating, like not in the session here and after, you can still write to me something you want to understand. And then like it's okay, we are in the same world. So uh, wherever like you need to be in touch, you can connect. And all the best, because you will be finishing your term, and so whatever I could mm, make it in whichever possible. So I have explained to you. Feel free to ask anything that you think. Otherwise, we call it a day, and then maybe we offline whenever we are comfortable, we'll connect. And yes, Mihir, like Mihir, if you have any issue or anything that you discussed with me previously, you can always talk to me about that later on.
Okay, sir. Sure.
Yeah. So anything that you find it difficult, so you can
Sir, can you please share your
talk to
mail
me.
ID?
So like, can you see the Excel? This
Yes, sir.
yeah, so I will write here in this Excel only. So, so and so this is my Gmail ID. Can you see it?
Yes, sir.
Yeah. So this is the Gmail ID where mostly I'm active, although I have other ideas also, but this is the most active use. So in case anything is there, you can write to me here. So I will have this access permanently, but the institutions access may not always, it's not always possible because I use mobile mostly. So accessing institutional email is difficult on mobile, the personal mobile. So you can write and then keep practicing. I think it's easier. But some of the thing model that you have done, you would have realized that it's very easy to do the same in R and Python, because they are very advanced software, very advanced. Means the way they have transitioned from the time they like they were started, it's really very difficult. So like if you're using the advanced version, sir, then you'll find it that okay, it is like very easy and somewhat cumbersome also some of the times. But the advantage of using Excel is like in Office you usually get this. Many offices still rely on Excel because they can develop their own on this, and this is relied because developed by Microsoft. Whereas the other analytics are still they can't subscribe to it because of the huge cost involved in that. So depends. So should I like call it a day, and then like we talk offline if I as and when anything is required. Otherwise, it's fine. Okay.
Okay, sir. Thank you.
Okay. Thank you very much.
Thank you, sir.